Hello traders, Gary Wagner here. Just before 2 o'clock in Honolulu, 8 o'clock in New York. I know that we have delayed the show, but it will be well worth the wait. It is Friday. Happy Aloha Friday, as we say on the island, July 17th, 2020. And this is the Daily Report for Gold and Silver, our weekend review. And what a week we have had. We saw gold last week break above $1,800 for the first time since the decline in 2011. We saw follow through, but more of consolidation this week. On today's show, I want to talk about our current trade, as well as our recommendation to rebalance your portfolio, weighting gold and silver heavily. And we'll talk about what our exit strategy is. But first, to the price board. Traders, we are ending the week on a very strong note with the precious metals across the board trading higher and dollar trading lower. First, to August futures, 18.1210, putting it up $11.80, almost 0.7% gain. When we look at spot, 18.0890, that's up $12.17. And we are starting to look at October because that will be the next contract month, 18.2320, at $11.50 gain on the day. Silver was pretty dynamic, gaining almost 0.9% at 1974.5. Palladium gained 1.25%, $2,050.50, and platinum also gained to the tune of $14.40 at $851.40. We have also recommended the accumulation in your portfolio as a rebalance of 3 ETFs. The first one that we have recommended is Nugget. That was up 6.31% today at 89.09. We also recommended GLD. That is the Spider Gold Trust, 170.12, up about 0.8%. Each share gained $1.39. And lastly, we are recommending the accumulation of SLV, which gained 1.29% and is currently trading at 18.01 after adding 23 cents per share. Let's take a look at our technical studies. Sorry for the delay in getting our show out today, but I think it will be worth the wait. This first chart is a 240-minute candlestick chart, continuous contract of gold. And what we have basically drawn is a series of channel lines defining upper level resistance as well as lower level support, starting from this low here and carrying it forward to the most recent low, which is here. Obviously, over this last week, we have adjusted this channel line, which was sitting approximately like this, a little bit higher, but the lows this week necessitated widening them. In terms of what we are looking at, we are still in a defined up channel. In the opening letter, we talked about the percentage gains over the last 6 weeks in both gold and silver, and I do expect them to continue. The question is, where might this first leg of a multi-leg rally conclude? And to that end, I am looking for anywhere between 1845 and 1880, and that is based upon the continuation of these channel lines. That being said, we have a different analysis that's available when we look at our daily charts because we're able to really isolate a series of highs that came in the market, and the only high that has not been taken out at this point and therefore is an area of resistance is this recent high at 1829, which means that our prior assumption of seeing this first leg go between 1840 and 1880, we have to overcome this key level at $1,829 per ounce, which takes us to our current trade and what I'm recommending in terms of a strategy. Under the assumption that we have seen this market rally as a series of stair steps with higher pricing and then a small retracement, higher pricing, small retracement, now that we have effectively hit this new low here and we're on our way up, we are in at 1807, markets at 1812. I am going to look to liquidate it at approximately 1829 to 1830. That is this top here, about halfway through this particular channel, unless it just runs through that, because first day notice will actually come in about a couple of weeks. We will then look to switch to the most active October contract in a couple of weeks, and we will attempt to actually initiate that position along the bottom level of this channel. In other words, my recommendation is try to cover and pull profits on our current position, and then if the market continues to be channel bound, look to pick up an October position a few days later, maybe a week later, when it hits the bottom of the channel. So for now, my recommendation is to maintain your current position as well as your stop, which takes us to our long-term projection, and this is based on Elliott wave as well as Fibonacci extension. What we are simply doing is taking the price range that was achieved during this third wave here, when gold was trading at approximately $13.90 up to the former record high at $12.88. And then looking for the conclusion of the correction that we are labeling as a fourth wave. And then from this bottom area, we are then adding a 0.618 projection or extension of wave 3. And that study concludes that we could see gold rise as high as $1,920 by the conclusion of this rally. But as we have talked about all week, we are not looking at a parabolic move, but rather a wave count that will be something like a 1, 2, 3, 4, and 5. This would be where we conclude at 1920. We are looking at a 240-minute contract of Forex or spot gold, and we can see that it is also range bound within this channel, trading to the upper ends before selling lower and then finding support at these lower levels. The key difference between trading spot and trading a futures contract is the cash market doesn't have an expiration. So what is different is we will look to pull profits when it hits the top of this range, and I would recommend when we actually pull profits on our futures position that Forex or spot traders go ahead and pull profits on that. However, when we rebuy once it hits the bottom of the range, you're simply going to rebuy spot. There is no contract month in Forex. Maintain your long spot position as well as your stop. We're looking at a daily chart continuous contract. This represents September silver futures. That's the most active contract for that. You can see our basic fib retracement beginning at the highs above 21 down to these lows that come in below $12 per ounce. And when we do that, we can see that the dynamic move that occurred in March was phenomenal, considering it went from about $12 to almost $20 in a period of time of a couple of months. Now, what is key and important to us right now is the top that exists right here, which occurs just below $20. And we'll go ahead and blow this chart up so that you can more accurately see what I am talking about. That what we have seen, and we can create a horizontal line to convey that, is that the effective close, which is right here, comes in just at the prior high. So this could be a little bit of resistance at 1975. However, I believe that if gold tracks higher, silver will do so also. Our upside target remains $21 to $21.50 for silver. For those trading silver, maintain your current long position as well as your stop. And subscribers, as you recall, at the end of June, we made the recommendation of rebalancing your overall portfolio, your stock portfolio, to have it weight more heavily in gold, GLD, as well as NUGT, meaning Nugget, which is a mining ETF. We got into GLD position at roughly 166 per share. It is currently trading at $170 and change. The next ETF we are going to look at is Nugget. Now, Nugget is one of the electronically traded funds that does have some volatility because there is a 2x leverage on that. Back at the end of June, it was trading at 73.08. Currently, it's trading at 89.09. And traders, we most recently added SLV, which is the iShares Silver Trust, to the part of our portfolio that will include ETFs. You can see that that has moved up dramatically from the lows in March. It has consistently, week over week, closed at a higher price. We just got in a couple of days ago. We are currently about even, not showing profit on this particular ETF yet. Traders realize the ETFs are not trading items, rather, they're a buy and hold strategy. This has been Gary Wagner, wishing you, as always, good trading. Have a great weekend. We will talk to you on Monday for the next daily update and review. Stay healthy. Bye-bye.